This video takes a look at Chapter 9, and the topics being internal control and cash. We're going to focus today looking at internal control, and one aspect of internal control that you're likely to encounter when you get out there in the work world, which is the use of a petty cash fund. And we're going to use it not because I want you to become an expert on petty cash funds, but you're likely to encounter it. But our purpose here is to take a look at the journal entries required to set up and manage a petty cash fund. You'll learn about petty cash, but also how to analyze that and think about how to analyze for journal entries, which is an important skill. So the learning objectives then, we're really going to talk about defining cash and explain how it's reported. We've talked a lot about cash, but we've never really clearly indicated what that is, although you probably have an inkling. And we're going to, like I said, explain how to record a petty cash fund. All right. Internal control. You're going to hear a lot about internal control when you get out there in the work world, and it might not be explained quite like that. They might not even use the phrase internal control, but you will see aspects of it. Basically, it's all those policies and procedures that we use to protect our assets and make sure that the information that we're recording is accurate and correct, and all policies associated with that. Typical things you might see are things like two people required to when cash is being counted. You don't leave one person alone with all the cash who's going to keep taking care of the records. You're just kind of inviting disasters. You may have encountered that in other environments, internal control, certain transactions require certain authorizations. You may have encountered things where you can only do a transaction if you have photo ID. That's an internal control measure to ensure that whatever happens next is happening to the person that it's supposed to happen to or for. If you're going on to study, in the area of accounting, then these things will become more important to you. But for our purposes for this course, it's just more for your information. You're welcome to read through these slides. There's about 4 or 5 slides in the student notes that cover off the internal control and its limits. We're going to focus our discussion today on one aspect of internal control, and that has to do with the controlling of cash. Cash, important to every organization. Every organization has it. They like to keep good control on it. They don't like their cash to wander away without them knowing where it's going. So cash, and the thing about cash itself is it's pretty sticky in that if you leave it laying around, it will stick to just about anybody walking by and it will just wander away. So internal control of cash is incredibly important. And one of the first rules of internal control of cash is don't have cash laying around. So like I say, access to it, control of access to cash is critical. And just definition-wise, when we talk about cash, we're talking about, of course, the things you think of as cash being currency and coins, but also checks. When we've made transactions and we've included cash, it's kind of been not clear sometimes whether we're talking about actual cash or money in the bank or whatever. It turns out all those things are cash. Cash can leave the company in the form of currency, like $20 bills or euros or whatever the currency of exchange is. Or it can also leave the building in the form of checks. It could also come in that way, of course, in the form of currency or in the form of checks. So anything you have on deposit in the bank is considered cash. So when we write a check, even though the money hasn't actually left the bank until whoever we wrote the check to cashes the check and the bank gives them the cash, up until that point we still have the cash, but we record that it's disappeared out of our account because we've given it away. That just whoever is getting it hasn't taken it yet. And other items that are acceptable for deposit are also considered cash. For our purposes, basically, it's money in the bank accounts and the cash or currency or checks either coming or going. So internal control of cash basically has there's some simple rules for this. One is the handling of cash versus record keeping. Make sure you have separate people doing that. And some of you may have experienced that where you are maybe the cashier at a retail establishment, and at the end of the day, you prepare a report about how much cash should be in the drawer, and somebody else may count the cash and verify that. So there's always two people involved verifying that what cash is supposed to be there is in fact supposed to be there. Second rule, don't have cash laying around. Every day, make sure you go to the bank and deposit your cash. If it's laying around, it's probably not safe. It might be in a safe. Speaking of safe, you could put the cash in a safe, but ideally we take it down and we deposit it. Sometimes that's a night deposit. The bank is already closed and we throw it into a night deposit. deposit box. Third rule is don't pay for things with cash. Cash is really hard to keep track of because all cash looks alike. So we tend to use checks to pay things, to make disbursements. And we tend to use checks. Now, there is a possibility that I'm talking about checks and you have not, in this day and age, might not have actually seen one. But remember, businesses today still do many of their transactions using checks and now electronic funds transfers, but checks are still very prominent. So it's a document where basically you fill out who's getting the money and how much, and then the authorization is some signature on it. So just in case you're not familiar with what a check actually looks like. Okay. So how do we control cash leaving the company? We'd like to know when it's leaving. We'd like to know it's leaving for all the right reasons. So basically, if cash itself goes, it makes us nervous because, like I say, all cash looks pretty much alike. So we make all our disbursements by check or electronic funds transfer. Authorization or the actual signing of the check versus the record-keeping duty should be separate. So lots of times you'll see the person responsible for preparing the check, making out who's supposed to get the money and how much. They've got documents that include things like an invoice or some sort of authorization to pay. They get all that documentation together, and then they go to somebody who actually signs the check, who then verifies that all that documentation is correct and accurate, and we're paying the right person the right amount for all the right reasons, that it's a real business expenditure and all those sorts of things. That system is actually called a voucher system, which is where we have all those documents together that prove and authorize the release of a check or money actually leaving the company. I said we pay absolutely everything by check, and that's true as long as we can get away with it. So good internal control procedures require cash disbursements be made by check, always, except when you're paying little tiny amounts. So here's the exception. Small payments required in most companies for items such as postage, courier fees, repairs and supplies, office party birthday cakes, sandwiches for the lunch, boss getting his car washed, all kinds of little small expenditures that writing a check for them really doesn't make a whole lot of sense. They're small, they tend to pop up, we don't have time to get a check through the whole authorization procedure, and so we have to pay with some small amount of cash. And so we established something called the petty cash fund. Now, how do we go about doing that? It turns out, while you may have heard of petty cash before, there are lots of transactions, lots of payments going on through petty cash. They tend to be small, there's lots of them. Interestingly though, the only time we ever make an entry to the petty cash account in the general ledger is when we first set up the petty cash fund. We had a general ledger account called cash. What we're doing now is we're establishing another little account that's called the petty cash fund. And what that general ledger account keeps track of is how much should be in the petty cash fund. Now there's never exactly that amount in it, that actual cash in it, and that's what we're going to talk about. So to set up the fund, we basically transfer some money out of our primary cash or bank account or whatever. We write a check, and we convert it into cash, and we stick it in a little steel box probably, and in the general ledger we debit petty cash. This is this new general ledger account. And what that represents is this little tin box that we give to one person to control, and this is the important part of it. One person has control of that. Often it's the receptionist. It's got to be somebody who's reasonably handy, because as we make these little transactions, we need somebody who's there to actually give us the cash. So there's one individual, and in fact that petty cash check is made out to them. Let's just call her Matilda, just to keep things clear. So Matilda gets a check for $150. Matilda wanders down to the bank, cashes it, gets lots of small bills and some coin, and then she comes back and she puts it in a little steel box that is in her possession. So this is Matilda's petty cash fund. Over time, people come by and they want money out of the petty cash fund. Well, Matilda just doesn't give them money just for no reason. They actually have to have a reason for doing that. So, how do we operate it? The petty cashier makes payments from the fund for small disbursements. And small, like we said, lunch, the birthday cake for the office party, or those sorts of things. And this is the important part from Matilda's standpoint, because Matilda has to make sure that she gets a receipt for everything that she pays out. And that's usually the receipt from the grocery store for the cake or the bakery, or the car wash for the payment for the boss's car wash, or whatever, postage, the receipt from the post office for postage that we paid, those sorts of things. So they actually get a receipt. So Billy Bob has gone down to the local office supply place and purchased some office supplies for the office, $12.45. We didn't know how much it was going to be. Somebody said, go get some highlighters and some pads because we're having a meeting or whatever. And Billy Bob goes and buys that. He comes back and he has a receipt for $12.45. He goes to Matilda, hands Matilda the receipt. Matilda gives him $12.45, and the receipt goes in the petty cash box. And this is key because now in the petty cash box, if we don't have the $150 that was in there in the first place, we should have receipts accounting for the difference. So if we count the cash and we're $12.45 short of $150, it's because we gave $12.45 to Billy Bob for the office supplies. And that'll go on for a while, but eventually we're going to run out of money in the petty cash fund. There will be no cash in the petty cash fund. There'll just be a box full of little slips of paper like this. So what do we do about that? Well, here's what happens. Every so often, Matilda goes, hey, I'm low on cash. And she goes through and figures out how much cash she has, and then says, okay, I need to get this back up to $150. So let's just say, for the sake of argument, that she counts up everything and she discovers that she's paid out $126 for stuff over the past couple of weeks, say. And it turns out that all that has to do with postage. The boss didn't get his car washed, we didn't have any birthdays, whatever happened here. Postage and courier expense totaling $126. Now the fund was $150, so if we're looking for $126 to fill it back up again, we know that there must have been $24 still left in the fund. So $24 plus this $126 should bring it back up to $150, and we turn in all the receipts. So since we're writing a check, we know that we're going to have to credit cash because cash goes down when you write a check. So cash goes down by $126, and we record the things we debit are the things we paid for out of the petty cash fund. So we debit postage expense and we debit courier expense. Now, if for some reason the receipts didn't quite add up to the money that we're short because Matilda shortchanged somebody, or there was a mistake, or misread a receipt, or lots of things that can happen that can put us out by $1 or $2, we may actually need a cash short or over account. The book describes that fairly well. Now, the one thing to remember is this check for $126 is made out to Matilda. Okay? You'll notice petty cash is not mentioned here at all. This is a check that doesn't go to petty cash. The cash does. The check goes made out to Matilda. She goes, gets the $126 and puts it back in the box. Because remember, she's still on the hook for the $150 that's supposed to be in the steel box. Now, you might wonder about that since it's for petty cash, how come petty cash doesn't get mentioned here? Remember, what we're doing with the petty cash fund is we're kind of temporarily eliminating issuing a check. We could have just as easily, well, not just as easily, because if it was just as easy, we would have done it. But we might have gone down to the post office and gotten some postage and paid with a check. Imagine if we had done that. We'd gone to the post office, we bought $46 worth of stamps, and we paid with a check. We'd see an entry that said, debit postage expense, $46, and credit cash, the $46, because that would be the amount of that check. We didn't do that at the time. We paid whoever went for the postage, we paid them gave them the cash, and now we're essentially writing the check to compensate for that. So we're topping up the petty cash fund, but the balance in the petty cash fund hasn't changed. It's still sitting at $150. Whether we're paying recording to take stuff out of petty cash or to reimburse the petty cash fund to top the cash back up to the original $150 or whatever the balance was, because not all the petty cash funds are $150. Then that is cash coming out of the bank, and for what reason? Is to pay off all these expenses. These people already have the cash, so we take the cash and we put it where we essentially borrowed it from, back in the petty cash fund. Now, exercise 9.6 in the textbook is an excellent example of how this actually works. And like I said, I'm not trying to make you an expert in petty cash funds. You should kind of understand how they operate. Matilda's running the petty cash fund. She's on the hook for it. She's going to demand receipts for stuff, occasionally get it topped up, and the money goes back in a little steel box. And hopefully it's always in this little steel box. We always have cash and receipts totaling whatever the petty cash fund is supposed to be. So exercise 9.6 is just basically asks you what are the general journal entries. These examples certainly should provide you with enough direction to be able to do that, so good luck.